This is how to grow your small trading account as fast as possible. I'm going to show you step by step exactly what you need to do. So the first thing is you want to pull up a watch list of things that you can actually use to trade. And we've just got a default watch list up at the moment that's got a list of underlyings with high options volume. You can use any watch list. We are product indifferent. It doesn't actually matter what you trade. And that's going to become more and more clear as we get through this video. So once you've got your watch list up, you want to have IVR, which is IV rank, on your watch list and order everything from high to low. And then if your broker allows you to, you want to filter out anything that has earnings over the next 45 days or so. You also want to filter out anything with a low liquidity level, so that we are left with only highly liquid underlyings. And once you've got everything set up in this way, you only want to look at things to trade that have an IV rank of at least 30. So in this instance, as you can see, our Roblox here has an IV rank of 30.3, and then everything below this is under 30. So we're not going to bother looking at that. We are going to take a look at Walmart. I do like trading Walmart. It's a nice kind of medium-sized underlying. 85. It last traded at $85.93 a share. It has a nice IV rank of 56.6, and its absolute IV level of 27.6%. Now, once you've selected your underlying, you want to pull up a list of option expiration dates for that particular underlying, and you want to pick one that's between 30 and 60 days out in time. Okay, if you didn't already know, if you're new to this channel, we sell options contracts. Okay, we don't buy them, we take the other side of the trade and we sell them. So we are effectively short options contracts. And so you want to pick an expiration date, monthly expiration date between 30 and 60 days out. There's one here, May 16th, 55 days away. As you can see, there is earnings on May 15th, a day before this expiration date, but we are planning to be out of this trade well before then. So we're just going to open up May 16th, and now we can see the options chain. We have this orange horizontal line. This shows us where the price of Walmart currently is with respect to these strikes. You have our vertical orange bar. This shows us what the expected move is of the underlying. We have our 1 and 2 standard deviation lines shown with these dotted blue lines here, our standard deviation level, sorry. Calls on the left, puts on the right. You also want to make sure you have delta on your options chain as well. So whenever you are short an options contract, you want price to stay away from that contract. Let's just go back to basics and pretend that you wanted to buy a contract. Okay, let's say you were to buy this 90 strike call. What you're saying here is that you think prices are going to go up. You think prices are going to go up higher than $90. Okay, and so your directional bias would be long Walmart in this instance. We're going to take the opposite side of the trade, so we're going to sell this, and now we want price to stay below $90. Okay, so that's the kind of general premise of selling or writing options contracts. You want price to stay away from that strike. So if we want price to stay away from a strike and we know what the expected move is, to get a high probability of success, we simply just need to sell contracts outside of the expected move, and we're going to get a high probability of success. The further out you go, the higher your probability of success will be, but the lower your return on capital will be because you're taking less risk. So a good medium for me, in my opinion, is to be between 15 and 20 deltas. This is why you need the delta column. So we've got an 18 delta here at the 95 strike. We're going to sell that. And we have a 17 delta on the put side at the 77.5 strike. We're going to sell that. Both contracts are outside of the expected move. Both contracts are up against the 1 standard deviation level, and both contracts are between 15 and 20 deltas. Now, the market is closed right now. It's a Saturday, so take these numbers with a small pinch of salt. However, the numbers aren't too far off what you'll see in a live market environment. So we want price to stay in between this range that we've created for ourselves between 77.5 and 95, and our pop, which is shown here in the bottom left, is probability of profit is 70%. So we have a 70% chance of making money on this trade. That's if we hold till expiration. But if you remember, we mentioned earlier, we're going to be out of this trade early. We're not going to wait all the way till expiration. And so I typically get out at 50% of max profit. And so our P50 here is 85%. So we have an 85% chance of being able to get out of this trade at 50% of max profit. So I personally wouldn't hold to the expiration, so our actual probabilities of success are going to be around 85%. Okay, in reality, it would be slightly higher than this. because implied volatility is generally overstated compared to actual volatility, and volatility is contracting most of the time in the market, about 80% of the time, and it's also mean reverting. So your actual win rate will be higher than this, but even if we just go with this number right now, this is really good. So 85%. If we were to get filled at this mid price of $1.69, we would collect $169 up front on this position, and our broker is going to require just under 2.6k in buying power to open this position. Now you're probably thinking this is a very low return, this is a lot of buying power, and you are absolutely correct. This video is for smaller accounts, larger accounts too, but geared towards smaller accounts. So I'm going to show you now how to still place this position, but with a less buying power and a higher return on capital, because that's typically what you want to do when you have a smaller account. You want to be aggressive in growing your account. So what you want to do is use some of this premium and buy some long contracts to cover your short contracts, because at the moment we have an unlimited max loss and we need to limit this max loss to reduce our buying power requirement. So let's just say we go $5 wide. So we're going to go to the 100 strike and buy that contract for 32 cents. And we're going to do the same thing on the put side, although we can't actually do it on the put side because of the strike selection. There isn't anything $5 lower. So what we're going to do is just going to move this up to the 80 strike. It's still at a 24 delta, which is pretty nice. We're just on the edge of the expected move, and now we can actually find a contract that's $5 away. So $75, we're going to pay 66 cents for that. And now what you'll notice is our P50 has dropped a little bit to 76%, but it's still 76%, which is super high. We're now going to collect $127 up front, and our buying power requirement is now only $373. So as you can see, this is significantly less than the $2,600 it was before, and now we collect $127 and we're risking $373. Our max loss is now defined. Okay. As you can see, we get a lower probability of profit, but a higher return on capital, and that's the trade-off. And something like this should fit inside everyone's portfolio. Just get out 50% or less, and you'll be absolutely fine. You want to do this over and over again as many times as you possibly can, keeping your buying power in check. And in order to do that, you need a kind of template to work off of. So we've created one for you. If you click the link in the description, it will take you over to this page. Just click on the free position sizing template, and it will take you over to the spreadsheet. The way it works is you enter in the size of the portfolio that you have. Say if it was $25,000, you can then enter in whatever the current VIX level is at the time. Say if that was 32.8, and then everything's going to be calculated for you. And as you can see, you just need to use this information to structure your portfolio and form the backbone of your portfolio. Over the long run, you're going to be absolutely fine as long as you stick with this. If you would like to learn in more detail about what we do and how we do it, again, the link will be in the description, but this time click on EDS Premium. Get yourself signed up. You will have access to one of our portfolios where you'll be able to see the positions that we place, how we manage risk, how we make adjustments. Everything is in real time, so you can reverse engineer it and study, or you can just simply copy us. There's a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's also a private community, so if you do get stuck, you can speak with myself directly or with other like-minded individuals. And there's a 100% money back guarantee. So if that all wasn't enough for you, once you've been through the course and followed some of our trades, after 6 months, if you're not profitable, we will work with you for free until you are, or you can just request a full refund. So it is completely risk-free. It's $9.99 a month to join. The price will be increasing. Once you're in, the price is locked in for you for life. We've got members inside that are having great success right now, and our aim is to get you to a point of where you are completely self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.